This video is for Financial Systems in Canada, FIN 1003 GBC, and today we're looking at Chapter 4, the meaning of interest rates. Learning objectives for this chapter is 1. Calculate the present value of future cash flows and the yield to maturity on the 4 types of credit market instruments. Number 2, recognize the distinctions among yield to maturity, current yield, rate of return, and rate of capital gain. And finally, 3, interpret the distinction between real and nominal interest rates. Measuring interest rates. How can we compare cash payments, cash flows of different amounts and with different timing? Well, we use the present value technique. A dollar paid to you 1 year from now is less valuable than a dollar paid to you today. Because if you're paid a dollar today, you can invest it in something. That dollar will grow, and it's worth more in the future than it is today. So consider a simple loan. Loan $100 today and require a $110 repayment in 1 year. The simple interest rate is 10%. Let me bring up the calculator and show you. So if we have $110 ending minus $100 beginning, and we divide that by $100, the beginning, ending minus beginning divided by beginning, and we get 10%. So equivalently, at an interest rate of 10%, the present value of $110 in 1 year's time is $100 today. When we're looking at time value of money, I often like to draw a timeline. So in this case, we're only looking at 1 year. So you have $100 today times 10%. It's going to be $110 1 year from today. Okay? Because the interest is $10, 100 times 10%. So you borrowed 100, you have to pay back the principal plus the interest, so you're going to pay back 110. So on this slide, we're just repeating the simple loan example for other repayment dates, and we're looking at if we pay in 1 year, that we've done that, if we repay in 2 years, and if we repay in 3 years, okay? So you can see this slide has got a little bit of algebra here, and let's not worry too much about it because it's pretty simple. But it's just showing you that the way we calculate the future value is the principal amount times 1 plus I, which is the interest rate, to the power of n, which is the number of years. So again, if we look at year 2, we can bring up the calculator and just clear that off. So let's look at year 2. We can do 1 plus 0.1, so that's 1 plus the 10%. And then we do y to the x 2, and we multiply that by the $100, and we get the future payment of $121. But for those of you that are not great at math, I just want to show you an easy way to think about that. We started with the $100 loan, and we can just multiply times 1.1 for the first year, and we have $110 at the end of the first year that we owe. And if we just multiply times 1.1 again, then we're at $121 for the end of the second year. And if we multiply times 1.1 again, they're going to have $133.10, and that's what we're going to owe at the end of the year. It's $133.10. It looks like they did a little bit of rounding, okay? So when you look at 1.1 to the power of 3, all that is doing is 1.1 times 1.1 times 1.1. Okay, that's just a little quick math lesson. So just carrying on from the previous slide, we saw that the future value of the loan that we had to pay back was equal to the present value, the $100, times 1 plus I, the interest rate, to the power of n. So therefore, if we want to then calculate the present value, that's the algebraic formula for future value. Future value equals present value times 1 plus I to the power of n. So therefore, if we want to calculate the present value, we just do a little bit of algebraic rearranging. We divide the right-hand side by 1 plus I to the n, and we divide the left-hand side by 1 plus I to the n. And you can see then that this then crosses out. So, and then we just rearrange left side to right side. Present value equals the future value divided by 1 plus I to the n. So that's the algebraic formula. Bringing up the calculator again, if we just have that 133.10 at the end of 3 years, if we divide by 1.1, and then we divide by, that's the payment at the end of 2 years, divide by 1.1 again, we're at $110. That's at the end of 1 year. And if we divide by 1.1 again, then we're back to our $100 at the beginning of the 3 years. Okay? So what they're doing here is they're not showing just future value. They're showing also it as a cash flow. So the present value equals the cash flow divided by 1 plus I to the n. But cash flow is the same thing as the future value. Okay, so that just slides a little bit of algebra, fairly easy algebra, and fairly easy to do with the financial calculator as well. I just wanted to remind students that we're not going to get hugely into time value of money in this video, but in September 2018, I started a YouTube channel called Professor Ted Stevenson, and you can see that I've uploaded various videos for different classes. And this video here, FIN 1011, is for Finance Course 1011, and Chapter 2 covers the time value of money. So it's a good one to look at. I don't want to repeat myself. If you want more information on calculating time value of money, that's a good one. And also, this is a fantastic one, Calculate and Interpret the Future Value and Present Values. It's a 35-minute video to take you through how to use the financial calculator. Also, solve time value of money problems for different frequencies. That's 24 minutes. And then it gets a little bit easier, just interpreting, no math in these first two. Interpret interest rates as a required rate of return, and explain a interest rate is the sum of a real risk-free rate, etc. Okay, so just want to remind you that this is where I'm uploading some videos, and if you want more on time value of money, you just scroll through, find the relevant video, and watch it if you want to practice. This slide is looking at 4 types of credit market instruments. So the first is a simple loan, and it's just one payment at the maturity date. So that's the example that we've been looking at. Loan $100, have to pay it back at the end of 3 years. Okay. The second is a fixed payment loan, where there's multiple fixed payments at pre-specified dates. What would be an example of something like that? Well, it's going to be like a car loan. You buy a car and you make payments, fixed payments at pre-specified dates. Or we can look at a mortgage. When you buy a house, you borrow money from the bank and you have to pay back a certain amount of money every month. Okay. The third is a coupon bond, and in this video we're going to get into how we calculate the price and the yield on a coupon bond. And a coupon bond is a bond that pays fixed amount, the coupons, at fixed dates, plus a final payment, the face value at maturity. Okay. And the fourth type of credit market instruments is a discount bond. And what is a discount bond? It's a bond that pays 0 coupons, only a final payment at maturity. It's discount since the price is typically less than the face value. So you would pay, for example, $900 for the discount bond, and in the future you would receive the $1,000 face, and in the intermediate time there are no coupons being paid. Okay, some different names for that: 0 coupon bond, discount bond, strip bond, and no coupons on a discount bond. This slide is now introducing the concept of yield to maturity. And what is yield to maturity? It's when we calculate the interest rate. Okay, so there are several common ways to calculate interest rates. The most important is the yield to maturity. It is the interest rate that equates the present value of all cash flow payments received from a debt instrument with its value today, the current price. So we're going to go back to that simple loan example. If today's value is $100 and the payment due in 1 year's time is $110, then the yield to maturity was that 10%. Okay, on this slide, we're just going to be solving for the I, which is the interest rate, which is the yield to maturity. Okay, so recall the present value equals the future value, or the cash flow, divided by 1 plus I to the n. Okay, so we can see here that in the example that we're using on the $100 loan, $100 was the present value. You had to pay back $110 in 1 year. So that's the cash flow or future value. And n equals the number of years, which equaled 1. Okay. So you can see here, we're just going to do the algebra and solve for I, and that's going to give us our yield to maturity, our interest rate. So $100 present value equals the future value, or cash flow, 110 divided by 1 plus I to the n, okay? So if I just change the color of the pen for a minute and make it into a blue here, you can see that I can multiply both sides by 1 plus I to the n, and on the right, that's on the right-hand side. On the left-hand side, 1 plus I to the n, multiply by 100. We can see that on the right-hand side now, this crosses out. So then on the next row, we've got 1 plus I to the n times 100 equals 110. So now if I divide both sides by 100, this side will cross out, and we'll be left with the equation 1 plus I to the n, which is 1, so we remove it, equals 110 divided by 100. And if I write it out here on the left-hand side and take away the bracket, because n equals 1, 1 plus I equals 110 divided by 100, and then I want to isolate the I, we're just going to have I equals 110 divided by 100 minus 1. So that's just a little bit of algebra. And we'll bring up the calculator. So I equals 110 divided by 100. And then we minus the 1. And we get 10%. I equals 0.1, which equals 10%. And we solve the yield to maturity, or the interest rate, on that $100 loan that you had to pay back 110 after 1 year. So now we're looking at the second type of loan, and it's a fixed payment loan. And here they're saying loan value, LV, equals the fixed yearly payment, and N is the number of years to maturity. So it says here, how do we solve the loan value? We're looking at the fixed payments for each of the years in this case, and we're dividing by 1 plus I for the first year. That's you could go like this to the n equals 1, so that's why they're just showing the 1 plus I. This is year 2, the fixed payment divided by 1 plus I to the n equals 2, plus fixed payment divided by 1 plus I to the 3, etc., etc. Okay? So it's saying here that you cannot solve this by hand. We're going to require a computer, or we're going to use the time value of money functionality on the Texas Instruments BA2 Plus. Okay, in this slide, we're now going to be looking at the coupon bond and how we calculate the price of a coupon bond in particular. But I just wanted to remind us that we're looking at 4 types of credit market instruments in this chapter. The first was a simple loan. So that was the example where we had a $100 loan, and we paid back the $100 plus some interest at the end of 1, 2, or 3 years. So it was just one payment at the loan maturity date of the principal that we borrowed plus some interest. The second type of loan that we looked at was the fixed payment loan, where there's multiple fixed payments at pre-specified dates. So the example for that was a car loan or a mortgage payment, where you pay a fixed payments at pre-specified dates until the loan is paid off. So now we're going to be looking at a coupon bond. So I just want to bring up this description just to remind you that a coupon bond is a bond that pays fixed amounts, the coupons, at fixed dates, plus a final payment, the face value at the maturity. So we can see here that the price of the coupon bond is really just the sum of the future cash flows. So here's the first coupon payment, the second, the third, etc. Running along, you can see to the power of n. It could be a 5-year bond, 10-year bond, etc. But you just have to remember that on the final payment, you receive not only your final coupon payment, but also the face value of the bond gets paid back when the bond matures at the maturity date. Okay, so this is saying you can't solve this by hand. Well, actually you could. It would take you a bit of time. It can require a computer, or again, we can use our time value of money functionality on the Texas Instruments BA2 Plus calculator. So sticking with the topic of how we calculate the price of a coupon bond, we have this example here, and we're going to do it in Excel. We're also going to use the financial calculator. The example on the Excel sheet is Jones Co. has decided to issue bonds to raise additional financing for future growth. how much capital will it raise if it issues 1,000 10-year bonds with a maturity of $1,000 per bond and an annual coupon rate of 10% that is paid semi-annually? Jones has also determined that the investors require an annual rate of return of 12%. Okay, so the coupon doesn't match the annual rate of return of 12%. So here we can see the value of the bond equals the coupon payment never changes, and it's 10% paid semi-annually. So we know that that is going to be 5% every 6 months. So you can see the value of the bond is just the present value of the future cash flows. And this is why it's difficult to do it by hand, because you can see for a 10-year bond that is paid semi-annually, you've got 20 coupons plus the face value being paid back at the end of the 20th period, okay? So the interest rate, we're going to use the market interest rate for the to do the calculation. So in this case, 12% annually divided by 2 gives us 6%. And you can note there's a little bit of a mistake in this, is that this should be 5%, okay? So that was just like a little bit of a typo on this in this Excel sheet. That should be 5%. So the value of the bond is the present value of all the coupon payments plus the principal face value being paid back. So you can see here's the calculations being solved for you, and you can do it by yourself if you want. But at the end of the day, we've got a price of 885.3. And we can see the 885.3 is less than the $1,000, okay, of the face value. And why? It's because the investors require an annual rate of 12%. So that shows us that if we increase the interest rates, the price of the bond is going to come down, okay? Now you could work your way through this and using a discount rate of 5%, doing the 10%, and if you add it all up, you're going to get $1,000 if the market interest rate equaled the coupon rate, okay? Now, similarly, if the interest rates, if it was paying 10% semi-annually and they required an annual interest rate of, say, 8%, then as interest rates drop, the price of the bond is going to be increased and it's going to be more than $1,000. And that's getting, looking at prices of bonds that are either at par or they're being sold at a discount or they're being sold at a premium. A price of a bond is at par when the coupon rate equals the market interest rate. Bond will be at a discount when the annual rate of return is higher than the coupon rate, and the bond will be sold at a premium if the annual rate of return is lower than the coupon rate. Okay, so now let's move on, and we're going to solve this same bond first using the Excel, and then we will do it using the time value money functionality in the calculator. Okay, now we're going to look at how we calculate the price of a bond using some functionality in Excel. Okay, so we're going to use the same bond. That is a $1,000 bond face value that has a coupon payment of 10%. So semi-annually, that's a coupon of $50, 5%. The future value, face value, is $1,000. But remember, the yield on the bond that the investors want is 12%. So semi-annually, that is 6%. So that's the rate that we use for our present value calculations, okay? So how do we do it? On my Excel, I can click on this tab that says Formulas, and I click on the Financial, and I'm going to scroll down. The function is labeled PV, so it's PV, okay? So now we can see that we have what is matching. So the rate is 6%. We input that as 0.06. The number of periods is 20. We just click in 20. The payment, remember that's the semi-annual coupon payment. And the future value is the 1,000, okay? And we just click OK. And we've got 885.30 calculates the price, and it's 885.30. And by the way, you can see here, this is the Excel formula that is left in the cell. Present equals present value, brackets, 0.06 is the rate, comma 20 is the end, comma 50 is the payment, and comma 1,000 is the future value. Okay, so just do that one more time. Bring up the finance functionality. We're going to go to PV. For the rate, we type in 0.06. For the periods, 20. For the payment, 50 for the future value 1,000, and you can see it's also here equals negative 885 because that's money out of my pocket to buy the bond, and then I'm going to receive the future value, which is 1,000. With present value calculations, either the future value or the present value, one number must be negative and one must be positive. Okay, now we're going to do the same calculation for the price of the bond, but we're going to use the financial calculator. So the first thing to note, it's at semi-annual bond, so we need to change the periods per year to 2. So we check second PY. No, I'm set at annual, so I need to change that. So I'm going to do 2 and then enter PY equals 2, clear it off, and just check second PY equals 2. Okay? Then working from the left to right, we know that N equals 20 because it's a 10-year bond, semi-annual. So there's two ways we can do that. We can do 10 second and N. We got N equals 20, or we could just alternatively type in 20 and then the N. Okay? Now here, pay attention. We're not putting in the rate as 6% because we've changed the calculator preset to PY equals 2. So in this case, we just put in 12, the annual rate, 12 IOI, because we've changed the parameter PY equals 2. Okay? We're solving for the present value. We know the payment is semi-annual, $50, so we put that in as a positive. That's money coming into our pocket. And the future value of the bond is $1,000. It's also positive. It's coming into our pocket, future value. And then we're simply going to hit compute the present value, and we get the negative 885.30079, which is the same as this rounding, 885.30. Okay, so that's how we solve it using the time value of money functionality on the calculator. And again, there's a video on how to do that in more detail. So just to remind you, I do have a 15-minute video, which is how to calculate a bond's price giving a market discount rate. I'll take you through a couple of examples, okay? That will complement this video for this chapter. Now we're going to be moving on to how we calculate the yield to maturity using both Excel and the financial time value money functionality in the calculator. So we're looking here at a 10% coupon bond that's maturing in 10 years, and the face value is 1,000. So the first thing to point out, as I mentioned before, that if the yield to maturity, the required yield by the investors, equals the coupon rate, then the price of the bond is the $1,000. Now look at, if the yield of maturity required by the investor is going down, interest rates are going down, you can see that the price of the bond is going up. And as the yield to maturity rises above the coupon rate, then the price of the bond is going to be going down. Okay, that's just simple arithmetic. Increase the interest rates, going to decrease the price. Okay, or if we decrease the yield required, we're going to increase the price of the bond. That's how it gets adjusted so that the yield equals, we adjust the price so that we can get the yield that's required by the investors. Okay, so let's just bring up our Excel and run through this, how we solve this in Excel. So before we solve this in Excel using the functionality there, I just want to show you that it's really easy to use the financial calculator to calculate the yield to maturity. We're solving for the IOI. Okay, so again, it's a semi-annual bond, so we just want to check our PY. Yeah, it's still set at 2. So the price of the bond is $1,200. We're going to make that a negative because that's money out of our pocket to buy the bond. The coupon is 50 every semi-annual because it's 10%. That's our payment. The future value is 1,000, and those are both positive because it's money into our pocket. And the N is 20, N, and we simply compute the IOI, and we've got 7.16 yield to maturity because we can see here that the par value is 1,000 and the coupon rate is 10%. So if the price has gone up, the yield to maturity or the interest rate has gone down. Okay, so then it's really easy to run through these. If I just change the price of the bond and leave all the parameters are the same, we could just do 1,100, make that a negative present value, and then compute the IOI, and we've got 8.4958, 8.50. Okay. Well, if we make it 1,000, just to show you, negative present value and we compute the IY, we're going to be at our 10%. Because if the price of the bond equals the face value, then the yield to maturity equals the coupon rate. Okay, so just changing that to 900 as a negative present value price, and we compute the IY. Now we can see that the price is below par, so our bond is being sold at a premium. The bond is being sold at a discount, so the yield to maturity is above our coupon rate. And finally, the last one, 800, negative present value, so it's being sold at a discount. Compute the IY, 13.73. Okay, so let's just bring up the Excel functionality now. So we're going to go to our formulas, financial, and in this case, we're calculating the rate. So we click here on the rate. Okay, so the number of periods is 20 because it's 10 years semi-annual. Payment is 50. The present value for the first one, we're going to make it a negative. Remember, it's money out of our pocket, 1,200. The future value is the 1,000. And here it's saying logical, if it's payment, it's 1 if the payment is at the beginning of the year, or it's 0. Well, the coupon payments is at the end of the period, so we type that, we hit enter, and that's giving us, you have to see that is giving us a semi-annual rate. So if you want the annual rate, we're going to have to take that and multiply it by 2, and we get our 7.16. Okay, so again, formulas, I'm going to click on financial, and we're coming down here to the rate. We'll do the next one. Number of periods is 20. The payment is 50. The present value is negative 1,100. And the future value is 1,000. Okay, so we can see here it's going to be 0.04. That's the semi-annual rate. If I hit OK, just let me increase the number of decimals there. That's the semi-annual rate. And again, if I multiply that by 2, we've got our 8.4959. And if we multiply that 100, just make it a nice round number, we've got our 8.495, which is our 8.5. Okay, so to use the Excel functionality, we're using the financial function of rate, and we can also use the financial calculator using the time value of money functionality, which I think is very easy to use. And by the way, if you're writing an exam for the CFP, you're not using Excel, you have to use your financial calculator. Okay, this slide is just putting into words what we saw in the previous calculation, 3 facts about coupon bonds. Number 1 is when the coupon bond is priced at its face value, then the yield to maturity equals the coupon rate. So we saw that when the price was 1,000 and the face value is 1,000 and the coupon was 10%, then the yield to maturity was 10%. Number 2, the price of a coupon bond and the yield to maturity are negative related. So as I said, as we increase the price, we're going to decrease the yield to maturity, or if we increase the yield to maturity that is required by the investor, then we have to decrease the price. Okay, so they're negative related. As the yield to maturity rises, the price of the bond falls. And then finally, number 3, the yield to maturity is greater than the coupon rate when the bond price is below its face value. That is correct. Okay, so when the price of a bond is below the face value, we say we're selling it at a discount. And when the price of the bond is above the face value, we say that the bond is selling at a premium. Okay, so that's it for this slide. Okay, we're getting there. I know this is getting to be a bit of a long video, but we've run through the simple loan, the fixed payment loan, and we've just finished with the coupon bond, calculating both the price and the yield to maturity. So now we're moving on to the discount bond. That's a bond that pays 0 coupons, only a final payment at the maturity. So very quickly, to calculate the I, the yield to maturity is the face value of the discount bond minus the current price of the discount bond divided by the current price. Okay, so it's very similar to ending minus beginning divided by beginning. So if we just bring up a quick example of a bond, discount bond that is face value of 1,000, but the price equals 950. How do we calculate the I? It's just going to be 1,000 minus 950 divided by 950. Okay, so if we just bring up the financial calculator. So we have 1,000 minus 950 divided by 950, and that gives us a yield of 5.263%. This slide is now looking at the distinction between interest rates and returns. Okay, so recall, if interest rates go up, the price of a bond will go down. And if interest rates go down, the price of a bond can go up. And because bonds can be sold on the secondary market, the price can go up or down. Now, if you hold it to maturity, you're going to get your face value back. But if you sell it before maturity and the price is changed, then you're going to have a rate of return. Okay? And so that is how well a person does financially by holding a bond for some period of time and selling it before the maturity date. Okay? So we can see here the return depends on the coupons received and the price for which the bond is eventually sold. So the return equals the current yield. We can see here C over PT, that's our current yield, plus we have on this side of the equation the price at the time that we sell it minus the price when we bought it, ending minus beginning divided by beginning. Okay, so don't get confused by the algebra and this nomenclature. P to the t plus 1 minus pt divided by pt is just basically ending price minus your beginning price divided by your beginning price. Okay, and that is either going to be a capital gain or a capital loss. If the price of the bond went up, you've got a gain. If the price of the bond went down, you've got a capital loss. The best way to illustrate this is through an example. We're going to see that in a couple of slides. But before we run through an example with some numbers, we're just going to put up some points as well. So the return equals the yield to maturity only if the holding period equals the time to maturity. So again, you buy a bond when it's first issued and you hold it to maturity, then the return is going to equal the yield to maturity. Okay. A rise in interest rates is associated with the fall in the bond prices. We've established that, resulting in a capital loss if the time to maturity is longer than the holding period. And finally, the more distant a bond's maturity, the greater the size of the percentage price change associated with an interest rate change. What is that meaning? It means as that interest rates change, a bond that has a longer maturity is going to have a greater percentage price change. Okay, and that's fairly common sense or intuitive. Just bringing up a couple more points as discussing the rate of returns and some changes in interest rates. So the more distant a bond's maturity, the lower the rate of return that occurs as a result of the increase in the interest rate. So for sure, we increase the interest rate, we're going to decrease the price. So the longer the bond maturity, it's going to have a lower rate of return. Okay. So it says here, even if a bond has a substantial interest rate rise, its return can be negative if the interest rates rise. Yes, because as interest rates rise, price will come down. That return can be negative if you sell the bond before maturity. Okay, this slide is going to take us through 1-year returns on different maturity 10% coupon rate bonds. So different maturities. This one has a 30-year maturity. This has a 1-year maturity, 10, etc. So they're different maturity bonds, but they have the same coupon, 10%. Okay, and what's going to happen after 1 year when interest rates rise from 10% to 20%? So I'm going to focus in on this column, this row first, and we're going to look at the years to maturity when the bond is purchased is 2 years. In this case, they're looking at annual pay bonds. So this is time 0, and the purchase price is 1,000. And the face value, the future value, is going to be 1,000 when we get our principal back. And it's going to pay us a 10% coupon, which is going to be $100 at the end of 1 year. And it's also going to pay us the $100 coupon at the end of 2 years. But what we're looking at is that if the interest rates rise to 20% from 10%, we know that the price is going to go down. So if we're looking at this row, the initial current yield is 10%. That's the coupon rate. The initial price was 1,000 when it was issued. But what is the price the next year when the rates have gone up to 20%. And it says here, a little star, that this is calculated using the financial calculator. And I just want to show you how we do that. We're going to bring up the financial calculator, okay? And I said this example is using a annual pay bond, so we're going to change that to 1, okay? And we can see that in this case, that we're looking here, the time to maturity is N is now going to equal 1, okay? Because it was years to maturity was 2 when the bond is purchased, but now we're looking at the price the next year, so it's after the 1 year. So let's just bring up the calculator and let's move it over here for a bit. So we're going to see that, so check second, PY equals 1. So the N is going to be 1. There's 1 year left, okay? Now the interest rate has gone up to 20%. And the payment is $100. That's the coupon. And the future value is going to be 1,000. That's the face value. And so we're going to compute the price, compute the present value. We've got negative 916.666. So they've rounded it to 917, okay? And then we can do our calculation for the rate of the capital gain. That is going to be ending 917 minus beginning price, which is our 1,000. And we're going to divide that by our beginning price, ending minus beginning, divided by beginning, divided by 1,000. And we get a rate of negative, a loss of negative 8.3%. Okay, if you just multiply by 100 to get it into a nice round number, we can see negative 8.3%. So we've got our rate of capital loss. So the rate of return on the bond, we can see I brought this formula from the previous slide. The return is the current yield, which is the 10%, plus the capital gain or loss, which is ending minus beginning divided by beginning. So that is column 2 for the current yield, plus column 5, and we get, therefore, 10 minus 8.3, a rate of return on the bond of plus 1.7%, okay? A little bit of practice, you could work on another row. For example, if you worked on this row, then to calculate the price here, N is going to equal 9 because you're calculating the price. It's initially years to maturity 10, but we're calculating the price for 9 years. So let's just bring up the calculator and do that again. So in this case, it's going to be 9N. It's going to be 10. It's going to be, the yield has gone up to 20 IOI. The payment is still that 100 payment, and the future value is 1,000 for the future value. And if we compute then the present value of the price, it's 596.90, which is the 597. Okay. So again, same thing. If we do 597 ending price minus our beginning price of 1,000 divided by our beginning price of 1,000 and multiply that by 100, you can see that we have got a capital loss of negative 40.3%. And so again, to calculate the return, the current yield of 10% plus negative 40.3, we get negative 30.3 for our rate of return. Okay, so a few numbers on this columns and rows with a couple of formulas, but I think it's not that difficult to calculate the rate of return. We're looking at the initial current yield plus the rate of capital gain or loss. And how do we calculate that capital gain or loss? Well, we need to calculate the price of the bond, in this case, after 1 year when rates have changed. Okay, so that's it for this slide. We're getting close to the end of this video now. There's 3 or 4 more slides, but thankfully there's no more calculations. There's no more calculator. There's no more Excel coming up. So the first thing we're looking at is interest rate risk. What is interest rate risk? It's the risk level associated with an asset's return that results from interest rate changes is its interest rate risk. So we can see that as interest rates increased, the price of the bond came down. So that is interest rate risk. So prices and returns for long-term bonds are more volatile than those for shorter-term bonds, which should make sense. And there is no interest rate risk for any bond whose time maturity matches the holding period. So what that's saying is if you buy a bond and you hold it to maturity, then you haven't suffered any interest rate risk. You're going to get the initial yield that you paid for. Okay, so just clicking on to the next slide, we're looking at real and nominal interest rates. You've probably studied this in economics before. A nominal interest rate makes no allowance for inflation, and real interest rates adjust for changes in the price level or inflation. Okay, so ex ante just means after, and ex ante means before, and ex post means after. Ex ante real estate interest rate is adjusted for expected changes in the price level because it's before. An ex post real interest rate is adjusted for actual changes in the price level because you can observe it, it's after the fact. Here we just have one slide with the Fisher equation. That's a bit of economics review. And it's saying the nominal interest rate equals the real interest rate plus the expected inflation rate. Okay. And finally, the last slide talking about the Fisher equation is that when the real interest rate is low, there are greater incentives to borrow. That's true. And we've been in a low interest rate situation for the last several years. Low interest rates reduces the incentives to lend, and the real interest rate is a better indicator of the incentives to borrow lend. And finally, just one last slide, which was showing a chart from the textbook. It's showing the nominal interest rate and the estimated real interest rate. Okay, and this is a 3-month Treasury bill from 1953 to 2014. We like a lot of graphs in this textbook. And that's the end of this video for this chapter, and thank you very much.